Okay, we're now on step 6 of the accounting processing cycle. Step 6 has us recording, adjusting journal entries. We can note that we have 3 different types of adjusting journal entries: prepayments, which we refer to in Accounting 111 as deferrals, accruals, or estimates. Now, the main difference between prepayments or deferrals and accruals is that prepayments or deferrals has a previous original journal entry that has postponed or deferred something to the balance sheet. Our job with the AJE is to move it from the balance sheet. So during the AJE process, we move it from the balance sheet to the income statement. That means that something on the balance sheet is going to decrease and something on the income statement is going to increase. Now, keep in mind, this does not mean that net income necessarily is going to increase, but something on an account on the income statement is going to increase. Accruals, on the other hand, do not have an original journal entry. Instead, a circumstance exists in substance that we haven't yet accounted for. With estimates, we can have situations where we don't fit neatly into a deferral or don't fit neatly into an accrual because of the timing of cash flow or the fact that cash may not exist at all. And so because of that, we might classify some of our AJEs as estimates. Examples might be depreciation or bad debt expense. We'll start by looking at prepayments. With prepayments, this occurs when cash precedes either the expense or the revenue. We can have 2 different types of prepayments. We have deferred expenses, which are going to deal with an asset sitting on the balance sheet. Remember, with deferrals or prepaids, we've postponed or deferred something to the balance sheet. Or we could have deferred revenues, which deal with liabilities on the balance sheet. But again, something has been postponed to the balance sheet. Let's look at an example here. Here we have an example of a prepaid expense. They indicate for us that they've purchased $2,000 worth of supplies and that they have an ending balance of $1,200 at the end of July. And so essentially what we want to do is record the AJE to move the supplies of $2,000 from the balance sheet over to the income statement. But the question becomes how much has been used. Let's start off with the original journal entry. Originally, when supplies were purchased, we debit supplies and we'll credit however we pay for it. We'll assume cash right now. The amount that they tell us was purchased was $2,000. Now it tells us that we have $1,200 left. So we create a T account like they've done for you over here. We show supplies, and we've started with a beginning balance of $2,000 after the purchase, at least. Beginning balance, I guess, was 0. And then we have an ending balance here of $1,200. Now we need to make this T account actually calculate. So 2,000 minus what, or the credit side, is going to give us $1,200 as an ending balance. And that's how we get our AJE. So our AJE for this prepayment is to debit supplies expense, increasing the expense account, and decrease supplies, decreasing the asset account. Again, like I said, something is moving off the balance sheet and on to the income statement. But as you note, an increase in expense doesn't mean an increase in net income. So again, we just mean a component of the income statement is increasing. Okay, let's go ahead and move over then to another example of prepaid. This time we have prepaid rent. So here we show prepaid rent of $24,000, representing 1 year's rent in advance. The original journal entry that would have happened, debit prepaid rent. And this time we know it's cash. We don't have to assume because you can't prepay without actually paying. And so we have $24,000 as our amount. This represents a full year's worth of rent. So we're going to take $24,000 and divide that by 12. This produces for us $2,000 per month. They tell us that they paid this at the beginning of July. They're now doing a journal entry as of the end of July, so it'll be 1 month worth of rent that gets used up. Remember that prepayment AJE, the deferral AJE, is now attempting to show the use. So we debit rent expense and credit prepaid rent, decreasing something on the balance sheet, increasing something on the income statement. And what you should notice here is that assets are going with expenses when it's a deferral AJE, okay? Let's move on to another one. This time we have a deferred revenue. Still a deferral, but this time we're not dealing with an asset, we're dealing with a liability. Here it says that Dress Right Clothing subleased space to a jewelry store for $500 per month. On July 16th, the company that they're subleasing to paid $1,000 in advance for the first 2 months worth of rent. Now we're on July 31st. Our journal entry when we received that rent in advance was to debit cash, the amount of $1,000, and then credit deferred rent revenue because we have not yet completed our performance obligation. In other words, we have not provided the good or service that is owed to this jewelry store. So if we look at this, it tells us they paid on July 16th, and this is for the first 2 months of rent. So essentially what we're going to do is take this $1,000 and divide by 4 because we want to change it into 4 parts. In other words, a half month rent, and there's 2 months rent paid in advance because we're looking to get the period between July 16th to July 31st, which would be a half month. And there's 4 half months in the 2 months of rent. So we divide these out. This gives us a total of $250. We'll debit deferred rent revenue. Again, this is our AJE. We'll debit, this was our original, deferred rent revenue, which decreases a current liability here because we've now provided that service, we've allowed them space, and then we increase rent revenue, increasing the revenue account. Again, something on the income statement goes up, something on the balance sheet goes down. Okay, we're going to go ahead and try a quick concept check. You can pause this and try this problem yourself, and then we'll look at it together. Okay, let's go ahead and solve this. It says the correct amount of prepaid insurance was shown on a company's balance sheet as of December 31st, 2018 at $1,400. It then says on May 1st, 2019, the company paid additional insurance premium of $1,100. On December 31st, 2019, the balance sheet amount that was correct was $1,000. They want to determine what was the AJE to make that balance sheet item correct as of December 31st, 2019. So let's again do a T account here. We're going to have insurance or prepaid insurance here. Initial amount that we have for beginning balance was $1,400. They then say that we purchase an additional $1,100, bringing it up to $2,500. They said the ending balance was $1,000. And so again, our AJE has got to be this credit side to make this balance. And so the amount that we get from $2,500 to $1,000 is going to be $1,500. And so C is going to be our answer. Okay, let's now move on to accruals. Accruals involve cash flow that occur after either the expense or revenue recognition, whereas previously the prepaid was before the expense or revenue recognition. With accruals, we have accrued liabilities and accrued receivables. Accrued liabilities are going to go with expenses, and accrued receivables are going to go with revenues. Note when we have accruals, unlike deferrals, when we have accruals, something on the balance sheet is going to go up and something on the income statement is going to go up. In the deferrals or prepaids, it was something on the balance sheet goes down and something on the income statement goes up. Here, both something on the balance sheet and income statement are going to go up. Let's go ahead and take a look at a accrual that we have. The first one they give us is salaries. They tell us that the clothing company paid employees $5,000 for the first half month of work. And then they tell us for the second half of July, they're going to pay them in August. So as of July 31st, those workers have still worked, and thus we've incurred a cost. So even though we have not yet paid them, we have to record in the financial statements the AJE, debit salaries expense, credit salaries payable. Now, you might be wondering, where is the original journal entry that we're adjusting? Don't forget, accruals don't have that. Deferrals have a previous original journal entry that's been placed on the balance sheet. Accruals do not. So this is just an instance in economic substance that exists but hasn't yet been accounted for. All right, let's move on to interest payable. For interest payable, they tell us that the unadjusted trial balance reflects a notes payable balance of $40,000. The company borrowed this as of July 1st. It's now July 31st. They say that we have a 10% interest rate. So again, we're going to do principal times rate times time. Our principal amount's $40,000. Our interest rate is a yearly annual interest rate of 10%. And so we adjust for time because the interest rate is yearly. And so our time is 1 out of 12 months, because remember, this happens on July 1st. It's now July 31st. So only 1 month of time has passed. Calculate that out. We get 333. Our journal entry is to increase our expense and increase our liability. Remember, we said expenses and liabilities are going to go together when we're talking about accruals, and assets and revenues are going to go together when we talk about accruals. AJEs. This is specifically the AJE. Okay, let's move on to accrued interest revenue. This time, we're receiving, or have the right to receive at least, interest instead of owing that. It says, assume that we've loaned another corporation $30,000 at the beginning of August, and the terms of the note call for a principal of $30,000 and interest rate of 8% in 3 months. It's now August 31st. Our journal entry that we're then going to do, principal times rate, annual rate, don't forget. Annual rate times the time, and that's why we adjust for time, because the interest rate is annually. And so we start at the beginning of August. It is now the end of August, so we adjust for 1 over 12 months in the year. This gives us $200. Our journal entry is debit interest receivable, credit interest revenue. Again, the asset interest receivable, that's what this is, a current asset, goes with the revenue account. All right, let's go ahead and try another concept check. This time it's revolved around accruals. You can pause this, and then we'll come back together and do it. Okay, let's go ahead and try this. This says Gary's Grocery borrowed $12,000 at an 8% interest annual on May 1st, 2018, with principal and interest due on April 31st, 2019. Company's fiscal year end is December 31st. What amount of interest expense would appear on the income statement as related to this loan? So they don't have to pay interest yet, but they do have to accrue the amount of interest that is owed because of the passage of time. So again, we're going to use principal times rate times time. We have 12,000 here is our principal times our rate of 8% times the time. So we started this on May 1st, 2018. So that means January, February, March, and April, or 4 months, have already passed. We're now trying to record this as of December 31st. So that means between May 1st and December 31st, we have 8 months out of the 12 months that exist in the year. This gives us a total of $640, so our answer is B. Okay, let's move on. We're almost done here with adjusting journal entries. We're going to go to estimates. Like I said, estimates can have few different types that don't fit neatly into the categories of deferrals or accruals. Depreciation expense, our adjusting journal entry would be debit depreciation, credit accumulated depreciation, which is that contra asset account. This increases an expense account, decreasing stockholders' equity. And the contra asset account is increased. We're going to put an XA for the contra account, but that actually decreases total assets. Okay. With depreciation expense, it's an estimate because remember, we're trying to estimate the use of a long-lived asset. And there's many different rationales that we can come up with. And in later chapters, we will. But for right now, we just want to be familiar with the adjusting journal entry. Bad debt expense is also an estimate, and there are many different estimates that we can come up with as well. Remember, we had defined prepaids and accruals as it related to the timing of cash flow, and neither of these actually involve the cash flow. When we talk about bad debt expense, our journal entry is to debit bad debt expense, which is an expense account decreasing stockholders' equity, and to credit allowance for doubtful accounts, which is a contra asset account, also decreases assets. And again, there's a few different ways that we can come up with this estimate of bad debt expense, and we will do so in later chapters. But for right now, it's enough to know that these are the journal entries or the adjusting journal entries that we might have related to estimates. All right, let's move on to preparing an adjusted trial balance. In order to prepare an adjusted trial balance, all we really do is take our unadjusted trial balance and account for the adjusting entries. This then produces for us an adjusted trial balance. In the in-between time, what you can do if you'd like is once you have the unadjusted trial balance, you can then update T accounts with the new AJEs and then ultimately place those T accounts in the adjusted trial balance to get the new trial balance. That's one way in which you can do it. The other way is you can simply take, for instance, the unadjusted trial balance, so accounts, and we commonly do this in Excel. Debits and credits here. And then we have our AJEs for debits and credits here. And then this becomes the adjusted TB over here, unadjusted TB. We have debits and credits here. And we sort of go down the line. So for instance, if one of the accounts that you had was accounts receivable, and another account that you had was revenue later on down the line, and you had a balance of 100 here, and I don't know, 500 here, because remember, not all revenue has to be accounts receivable. You could have cash as well. Anyway, just sort of making up a scenario here. And let's say you did an adjusting journal entry to accrue the amount of revenue that you have earned through the performance obligations you've completed and you have not yet collected, and let's say it was 20, we would debit accounts receivable, credit our revenue here. And so to bring these over for the adjusted trial balance now, we would then say we'll add the debits together for accounts receivable, so we get 120, and we'll add the credits together for revenue, so we get 520, and that will be how we get our adjusted trial balance. Either way works, and it's really up to you, but as we get more complex, I think moving in an Excel route is going to be useful. We use accounting software to prepare our adjusted trial balance after we enter in the adjusting journal entries at the close process, but this is how we might do it manually. Okay, moving over here, here's an example of what an adjusted trial balance looks like. So notice over here you have an unadjusted trial balance, and then over here adjusted. There's many more accounts that we have included. After salaries expense, you know, there's a lot more accounts that we've actually included. Almost all of these are new here for our AJEs, but then some of the accounts are also adjusted previously. For instance, you can see that prepaid rent here previously had a balance of $24,000. Now it only has a balance of $22,000. And that's because we recorded rent expense of $2,000. So ultimately what we're doing with the adjusted trial balance is simply recording the adjusted balances after AJEs as opposed to unadjusted trial balance, which has not yet incorporated the AJEs. Ultimately, once you get the adjusted trial balance, you can start preparing your financial statements. But real quickly, keep in mind, this retained earnings here is still unadjusted in the sense that it has not yet had closing journal entries take place. So it does not yet encompass the activity of dividends or the income statement, which is revenues and expenses. Thus, when you're trying to include retained earnings on your balance sheet, keep in mind that you have to update this to the ending balance of retained earnings, which incorporates, again, the activity from the income statement as well as dividends. Otherwise, you won't balance.